Right. Thank you very much, Mark. And we want to welcome everyone that is joining us today for this particular webinar. We believe that we will be able to address some of the key issues that are really affecting the insurance industry, particularly in Africa. We know very well that the insurance industry is highly exposed to economic and also corporate clients that are highly exposed to ESG risks, but also these particular risks do come with opportunities. And as FSD Africa, we've been working closely with 3 countries, that is Nigeria, Ghana, and Kenya, to look at ways in which we can integrate ESG processes and even enabling them to have an environment, particularly within the regulatory space, for assessment of this particular risk. So we have been working for the last, I think, 8 months with the team from Genesis Analytics, basically to look at how best we could integrate these particular components of ESG. We know very well insurance industry really plays a very critical role in terms of building resilience, not only to communities, but also to the entire business environments. And these areas do really impact these areas are highly impacted with various types of risks. And it will be important for us to look at how then do we promote sustainability in terms of creating an environment that will be able to look at the future of the generations that will be coming to take care of and also to benefit from this particular part of the world. So we will continue engaging with the sector, the insurance industry sector, in terms of enabling them to look at how ESG can create opportunities, but also how do they manage these particular risks, particularly through the business operations in terms of strategy, issues around underwriting, but also just look at how then they can manage also their capital management processes. So we are kind of taking a 360 view of how ESG could be integrated within the insurance sector, and importantly, also bringing closer the regulators that do look at the stability, but also the well-being of the insurance sector. So we've worked with the sector, that is the insurance industry players. We've interacted with the regulators, and within the regulatory process, we've managed to develop a number of tools, and we will be able to share these particular tools that we've worked on. We've developed a guidance note that really will help the regulators in terms of setting up regulations and standards to guide the industry, the insurance industry sector, to an adoption of ESG practices. At the same time, developed a toolkit that will provide guidance within the sector. And these particular documents and instruments that we've created will go a long way in impacting the sector positively. And that's the only way as FSD Africa, we will be able to address the risks that are highly impacting this particular continent. I know all of you are aware of the impact of climate change within the region. For instance, in Kenya, we are currently experiencing the 4th year of drought. And that is something that was not happening in the past. So we can see how environmental issues have really impacted the continent. And statistics indicate that if we don't really take care of the climate change issues, Africa might lose around 30% of its GDP by 2050. So that means that there's need to really address these risks that are materializing in all particular aspects. And we cannot also forget the social issues that we are also experiencing in Africa. So for instance, every year you get close to 20,000 people try to cross over the Mediterranean to get to Europe. And if you ask yourself, why do these Africans really would like to basically get out of this continent, is because of the challenges that they are currently experiencing. And if we cannot really address such social issues, including child labor, then we'll not be able to make Africa to become more resilient. Over and above that, we know we are also working on other projects such as nature-based issues and importantly, it is indicated that around 23% of African GDP are also driven by nature. And you can see the close connection of what we are currently doing in terms of the integration of ESG with these particular challenges that we are currently experiencing. So we are happy to welcome all of you. And today we are just going to give you what we've come across in terms of ESG by working with these three great countries in the continent. This does not mean that we are not going to extend our work in other countries, the continent. This is just a start. We believe that by putting work together and really working closely with different sector players, the policymakers, the financial institutions, then we'll create the meaningful change that is needed in Africa. So I really appreciate the time that all of you have taken to join us. And without further ado, I want to just invite my colleague, Thomas Witches, who is our Assistant Director for Risk, to make a few remarks before I take it back to Mark, Mark, who will be giving us a presentation of the work that we've done for the last 8 months. Thank you, and welcome, Thomas.
Thank you, Elias. Good afternoon or good day to everyone on this webinar. So I don't want to take much more time than going through the whole reasoning and highlights of why FSD Africa is working on ESG in the insurance sector. Instead, I just want to add to what Elias has said by telling you a little bit about a parallel piece of work that we've been engaged with over the last couple of months, and that is to look at the industry and the ESG practices or the ESG understanding in the industry, the insurance industry in Africa. So we covered the same countries that Genesis Analytics covered from the supervisory angle, plus Egypt. That was a fourth country we added to the list. And we very much went into listening mode and engaged through the insurance associations, mostly the entire industry, through a survey and then through a couple of in-depth interviews with selected companies to simply understand how the perception of ESG risk in insurance looks like, what practices are already existing across the industry or in particular companies, and then of course to identify where the gaps are and where organizations like FSD Africa or the various associations at the national and then regional level could play a role in advancing ESG practices and performance to some extent. And I just want to highlight three conclusions that we're drawing out of this work. And by the way, the work will also be published at some point in the coming 3 to 4 weeks. It's currently being wrapped up. Point number one is that the practical application of ESG considerations in the business processes of insurance is really quite lacking. So there's quite an awareness in companies that ESG is something that their investors, the regulators, the society at large places on them as an expectation and perhaps even as a role. But what that really means in terms of reflection in the actual business of or process of underwriting, of client selection, of client servicing and claims payment, that is a real challenge to the industry. Then the second key point is that it's not clear, generally speaking, of course, it's not clear how material ESG risks really are for the clients and the sectors that the insurance industry in at least the countries that we looked at are serving. Yeah? So there needs to be a deeper dive into the materiality of ESG when it comes to certain sectors. And we know that some sectors are more relying on insurance than others in African countries. The sectors and the clients. Yeah? So large companies versus the emerging consumers or microinsurance business that many insurers are now also getting into, versus the public sector, which is a heavy or a big client of insurance companies. And then the third and last point is that while there is strong recognition, especially at the leadership or senior level, that ESG issues should be considered by companies, the internal reporting and review processes and systems aren't really existing. And maybe that's one area where to start as well. organizing and documenting the internal conversation that companies are having about their ESG understanding and strategy, and then working from there also to the other two issues or the other two recommendations and conclusions. So with that, I wrap this up and let's go back to the supervisory angle.
Great. Thanks very much, Thomas. Thank you, Elias. Sorry, Elias, is there anything else you'd like to add?
I think you can just proceed, Mark. Thank you, Thomas.
Great. Thanks, Thomas. Thank you, Elias. I think really nice foundation and indeed encouraging as well from our side to share some of the findings that we've had and how nicely they dovetail in with some of the findings from the work that Thomas has been leading. I'm going to share my screen again, so you'll see the agenda slide come up. Just to give you a sense of what we'll go through, I'll hand over to Ryan Short, who's a partner at Genesis and my colleague, to talk about ESG, why it's important and why it's controversial. We'll then go through this particular project that we've been running in Ghana, Kenya, and Nigeria, talk about findings so far, and as Elias mentioned, some of the tools and the guidance that we've built on that. And then we're very fortunate to have Mohamed Hafiz Isahaku, who's the head of Innovation Hub at NIC in Ghana, who happens to be on leave and has we're very grateful that he's given up his final day of leave to join us, to give us some of the perspective from inside the supervisor on this. And we'll then have some time for questions and close out. That said, Ryan, I'll hand over to you for briefly an introduction to Genesis and then to take us through ESG, why it's important and why it's controversial.
Thank you, Mark. And good afternoon, good morning, good evening, colleagues. I'm Ryan Short. I'm a partner at Genesis. I've been working with Mark and Elias and the team on this very important project. And I'm here just to make a few opening introductory remarks to set the context for ESG. I won't spend too long on this slide, but just so you know who you're dealing with, Genesis Analytics is an economics-based consulting firm operating across the continent and having a lot of diverse advisory services. For this particular piece of work, we've pulled on our teams in ESG, in regulation and policy, in insurance and financial services, and in stakeholder engagement. Thanks, Mark. Next slide, please. Okay, so I'm a partner at Genesis in a team that specializes in private sector impact. I've been involved in that for about 15 years, and I've probably been involved in the ESG journey in various parts of the world for at least the last 10 years. And typically we're working with companies, with investors, with regulators, with governments to bring in what you could almost think of as a more conscious form of capitalism. We are capitalists, but we do think that by asking the right questions, you can both enhance returns and you can enhance commercial and environmental and social sustainability. So what I thought I'd do is maybe just share some of that history with the group. I think it's always useful when you're having these conversations and before you jump into the detail, just to get some context. And what I'll do for the next 10 or 15 minutes is maybe just talk you through some thoughts on ESG, where it's come from, the state that it's in, and then maybe some of the controversies that have sprung up around ESG, which I'm hoping will provide useful and interesting fodder for conversation. So ESG comes out of a broader evolution in the role of the private sector and questions that have been asked about the role of business. Primarily, ESG came out of the investment markets. It first started being asked applied as a thematic lens over investment from long-term investors, and particularly the pension fund industry. And that makes sense, right? If you're taking a long-term investment bet, you want to know about all contextual risks to that investment, be it environmental or societal, social, or governance. So this ties in this interest in the context of investment has been mirrored in the role of business generally. And we've seen these changes over the last 10 years quite dramatically. If you think about where capitalism comes from and the first joint stock companies that were set up in the late early 1800s, it was an unashamed purpose of that corporate structure to be one that should drive profits and accumulate assets for shareholders, and to maximize those returns to shareholders. And that was pretty much unchanged for hundreds of years, actually. In the 1960s, it started to become quite popular for companies to have a strategic philanthropy arm. These were typically completely unlinked to the role of the business. They often went to the chairperson's spouse, whatever that person was interested in. Then there would be some charitable donations. In the 1980s, it merged into the era of CSR. And what that started to acknowledge was that companies are posited in a society, and that creates a responsibility on companies. But you can see even from that word responsibility, it's thought of as a must-do, a drag on business, a compliance issue, a moral issue. What's been changing from what we've seen in our work with corporates around the world, particularly in the last 5 years, is that there's now recognition that if you use society, and that by that I mean society and the environment, as a lens to look for business opportunities, then servicing those gaps in society and the environment can actually drive exceptional business. And so the idea of corporate shared value is now taking root. And increasingly, we can't believe how quickly it's happened with South African client base, East African client base to a degree, and especially in the European client base, how mainstreamed the idea of impact, ESG has become. It used to be sort of something on the side of business. Now it's right at the heart of boardroom activity and executive thinking. So it's not going anywhere. It's here to stay. Thanks, Mark. Next slide, please. So with these changing expectations of business, I think you ask here, what's the proof of that? Well, Edelman, the global PR company, runs a massive survey every year across the globe, 26 countries, including South Africa, Kenya, and Nigeria. They ask people, what do you think about issues of trust? And 3 things I just want to pull out from this year's Edelman Trust Barometer. Firstly, that there's a growing expectation amongst average people that business needs to step up on societal issues. It's being perceived as not doing enough to address societal problems. 52% of respondents agree that more needs to be done by business on climate change, 49 on solving economic inequality, 46 on workforce reskilling. And what's important is that stakeholders, this is not empty words. I mean, stakeholders will hold businesses to account for those expectations. So in the same survey, you see 80% of respondents, 80% saying they'll invest based on their beliefs and values. 60% would choose a place to work based on their beliefs and values. 58% will buy brands that are based on their beliefs and values. So consumers around the world are voting with their feet to move to companies that they perceive to have better policies with respect to the environment and to societal issues, and not just as an issue of compliance, but as an issue of leadership, societal leadership. So that's starting to lay the grounds for why ESG is starting to become such an important business issue, is because consumers care about it. And therefore, if you're investing in companies or insuring companies, you should be concerned about what their ESG policies and practices are. Next slide, please. Corporate purpose is also being redefined. And what this means is that you might think this is hot air, and many people do. If a company like Nestle 20 years ago was asked what is its purpose, it probably would have said to manufacture food. Or IBM would have said to manufacture computers. The concept of purpose is shifting very much from an activity to an outcome that the company is trying to achieve. So it's not making food as an activity for Nestle. Achieving nutrition for the world, that's an outcome. Now, the difference might seem slight, but it actually has very profound consequences, because if you define your corporate purpose as providing nutrition to the world, and you're serving and selling highly unnutritious products, that is going to change, that is going to drive a change of your activities and of your products and services over time. So there is a lot of hype around corporate purpose, but I do think that it is a valid statement of what valid purpose do companies think that they create in the societies in which they operate. What is its role in the world if everyone has their role? And so it's interesting that corporate purpose is changing rapidly, and is almost every global multinational would have a corporate purpose statement, just as they had a mission statement or a vision statement in the 80s or 90s. Thanks, Mark. Okay, let's jump into ESG against that backdrop and think about why it's important as a concept, and then also let's open up the thinking around why it could also be very controversial. So one of the problems with ESG is that everybody has a different definition of what it is, and that's been abused in the last half decade, as we'll see in a bit. But very broadly, a general definition is that ESG is a set of standards that when taken together, provide a framework for thinking about the impact and the risks of an organization beyond its financial performance. So it came out of the long-term investing markets, and it's asking what risks are there in this investment or in this organization that we're going to allocate capital to. The word risk for the insurers in the room, and I'm sure there are many, should immediately Miriam's asking if we can fit the slides to the screen, Mark. I think on my side, I think it is maximized. I think it is maximized, Mark, thanks. So what we're talking about here is a set of lenses that look at a investment or an organization or company and say, what are the risks in this organization beyond its financial performance? And as I was saying, the insurers in the room should immediately, their ears should prick up under the word risks, because that's exactly the business in which you're trading. So anything that is helping to assess the risks of an insured organization or its financial performance should be of interest. So there's some lists here. I'm always a little bit nervous of lists with ESG, because what's relevant from an environmental and social perspective is very customized to the organization and the country in which it exists and the region in which it exists. But I mean, almost certainly, you would want to be asking on the organizations that are being invested in or insured, what is the risk of climate change and carbon emissions to this organization? What is the risk of biodiversity loss to this organization? Does it have exposure to energy efficiency and water scarcity? Now, these sort of things may not matter if you're taking a short-term position on an organization. Maybe over the course of 6 months, a year, a few years, these risks are not going to make themselves materially known and affected in an investment or in an insured body. But if you're taking a long-term view, it would be pretty foolhardy not to be asking what, for example, climate change risks are applied. The social side is often harder to define, but you'd want to know, like, what is this company's diversity like? If it's not diverse, does that create a risk to performance? or is there a higher insurance risk in some way? Are the employees engaged? What are its community relations like? Is it observing human rights and labor standards, or is there a scandal just waiting to break? Is there social tension or a socio-religious tension in the area where it's operating that could lead into social unrest? These are all very valid questions to be asking as insurers and also as investors. And then the governance part is really talking about how well run is this company or organization? Is there a strong board composition? Is there independence? And so on. Thank you, Mark. So let's just recap. ESG is important because it provides some sort of framework to start asking questions about contextual risks besides financial performance. Okay, it provides a broad selection of risk analysis criteria, which means you can get a more holistic risk management picture. It can also be used to not only to maintain or mitigate risk, but to drive value creation. And it should improve the long-term sustainability of your investments and of your insured assets. Next slide, please. McKinsey has identified in quite a wide-ranging study in 2019 that ESG companies that had high levels of ESG performance, so they were asking the right questions internally, saw higher top-line growth, cost reductions, better regulatory and legal compliance, improved productivity, which is an interesting outcome, and it also provided a better investment and asset manager performance. Next slide, please. So on the question of, which is a really pertinent question, which is, does ESG actually drive better performance? I think that's a question of time. So there are plenty of companies that are being insured or invested in that have got terrible ESG scores that will still make a lot of money. I mean, Tesla is one of those, actually. Does really well on the environmental side, but very poorly on the social and governance side. The fossil fuel oil companies and coal companies at the moment would have terrible E scores, but are experiencing record demand and record highs at the moment. So there's no immediate short-term correlation between great ESG scores and better performance, or terrible ESG scores and poorer performance. The converse can play out in the short term, there's no doubt about it, in my view. But I do think that over the long term, if you're looking at insuring a partner over a 10, 15, 20, 25-year period, or investing in an organization over a long-term period, it just makes complete intuitive sense that you would want to look under every rock that you could for a risk that could affect that institution. So what we see on the screen here is also from the McKinsey study is that this is the respondents who say that these programs create value. You can see that they felt that actually short-term value is created by environment, social, and governance programs. But what's important is that there's also quite a significant change in long-term value of these investments. Next slide, please. Okay, so that's, if ESG is something inherently valuable for insurers and inherently valuable for investors, and improves company performance, then what is the downside? So the downside is that ESG has become whatever people want it to be. And asset managers in particular have recognized that consumers and investors are prepared to pay a premium on their fees for something that has an ESG stamp on it. And so how's that played out? It means that almost anything that can be stamped ESG has been stamped ESG, whether or not it's really considering environmental, social, and governance risks, and definitely not considering whether environmental, social value is being created. So there have been lots of examples of greenwashing and social washing. Just anecdotally, I a few months ago received a structured note product from my bank to say, did you want to invest in this? And one of the products was an ESG fund. And I went into the prospectus just to see what that meant. And what it meant is that fund would exclude arms and tobacco. So they would take out tobacco and any arms, and then they would take out the bottom 10% of the market for ESG scores. So effectively, what that fund, which was more expensive to invest in on a basis of fees, was offering me was 90% of the market. Now, that's not going to do anything to improve outcomes. So this is a real problem with ESG. Next slide, please. You may have seen last month, The Economist, which is an influential thinker in the world of the developments in business, completely took to task the concept of ESG. Said it had become completely muddled and completely greenwashed, and quite controversially, it proposed that the whole thing should just be scrapped, and the only thing that anyone should really be worrying about should be emissions. So let's focus all of the risk and all of the improvements on carbon. So next slide, please. I think that article, although it was provocative and maybe intended to be provocative, did actually offer many valid critiques of ESG. It doesn't really provide a clear direction for organizations to set goals. It can be completely gamed. Okay, it's a very imperfect measure of sustainability, performance, and contextual risk. It's very subjective and unclear. Some organizations see it as a risk measurement tool. Some of it see it as a value creation tool. Some of it point to their CSI programs. Sometimes governance is confused with government in some iterations. As we've said, it's been really abused by greenwashing and overcharging for these sort of branded ESG products, which clearly aren't really that different to any other form of product. And the ESG components, because it means so many things to different people and so many different organizations, it's very difficult to standardize and measure genuine performance and to benchmark that to something meaningful. So that said, I do think that in the African context, ESG still has a lot of value, though it does need to be adapted and it does need to be reformed. We can't pretend, and nor was it intended to be a complete measure of business impact or sustainability. It's simply a framework and a mechanism for asking about risk indicators that are non-financial in nature. It's also, as the Economist article suggested, focusing just on climate, I think is completely the wrong approach for a global publication. It feels very Eurocentric, that approach. In Africa and the emerging market context, there's so many other issues, particularly as Elias alluded to, so many socioeconomic issues that need to be dealt with and need to be considered, that focusing purely on emissions, to my mind, feels quite selfishly developed world, actually. And then I think in summing up, and I'll close here, is that ESG does serve a valid purpose. It can be a very powerful tool of assessing risk for insurers. It can be a very powerful tool for companies to improve their impact on the world. But it is definitely flawed, and it has been grossly abused. And if it can be reformed and we could develop it into a measure of impact rather than risk. So if we could measure the impact of organizations, both positive and negative, then I think it can still be a intensely powerful framework for improving the outcomes in the world and moving us into a more conscious form of capitalism. Thank you, Mark. I'll stop there.
Great. Thank you very much, Ryan. A reminder to everyone, please use the Q&A function if you've got questions. You're welcome to direct them at particular speakers, and I'll save some time at the end for us to cover those. So thank you, Ryan, for the broad context. We're now going to look very briefly at ESG specifically in the insurance sector, and then go into the current work that we've been doing with FST Africa in the 3 countries that were mentioned earlier. So at a very basic level, insurers need to understand ESG risks because insurers are in the risk business. So understanding environmental risks like pollution and climate change, understanding social risks such as the growing threat of cybercrime, and understanding governance risks, which can result in significant social and economic issues, massive brand damage for companies implicated in them. All of that, I think, is foundational to what we do in the insurance industry. So we have this definitional relationship with risk management. And it's important to note that these ESG risks aren't new. They're not new risks. It's just a helpful framework within which to identify and then mitigate those risks and hopefully improve impact at the same time. Of course, insurers also play a key role in transferring severe risks of many kinds in societies. The most obvious current example are climate risks, but of course there are many more if you look at things relating to rights and other societal challenges, natural disaster responses, etc. Insurers play a very critical role in those. But also we believe that insurers should care about ESG beyond that because many of their key stakeholders care about it and are demanding greater accountability on ESG. You've got regulators and governments who are interested in it. We've seen regulations and disclosures becoming increasingly popular. For example, I believe Brazil, which we think is a useful developing market benchmark on a lot of insurance regulations, had ESG regulations, which I think came into the effect at the start of August. Furthermore, ESG risks, like all risks, present an opportunity to insurers, an opportunity to develop solutions for customers. Understanding ESG risks and mitigating them because of that will also be key to the sustainability of individual insurance companies. So when you think from an individual insurer's perspective, there's the opportunity presented from the products, but there's also the risk mitigation that you need to do as an entity in itself, but also for the industry as a whole. So with all of that in mind, and Ryan has touched on a lot of this, we see ESG as really key to the sustainability of the industry. And if you think about the nature of the countries in which we work, it's very important to be delivering value to help to solve those societal issues, if nothing else, to ensure that you continue to have a social license to operate in those countries and in those areas. Having said all of that, there are, of course, challenges to doing so. We've covered a number of them in the upfront section, but one that we haven't talked about specifically yet has been data and risk quantification. Of course, for us in the insurance world, having data, having numbers to work with in order to assess risks and develop products around them is critical. And often in the case of environmental risks, social risks, and governance risks as well, trying to quantify these is difficult. So no one is saying that ESG is going to be easy to use. I think we're saying that it's important. And it is relatively new. What we're seeing is that there isn't really a universal list of ESG best practices in place, but we're seeing regulation and rulemaking evolving in some interesting ways. And I think there's some nice common themes to pull out. So some of the things we've seen, ESG is very much context specific. Ryan alluded to this. Countries have very particular socioeconomic contexts and also particular vulnerabilities. If you look at the V20 countries, for example, the understanding of climate-related risks in a V20 country is very different to a country that is less vulnerable, and the nature of those risks differs both in type and in severity. So what we are seeing and what we firmly believe is that ESG guidance and assistance to the industry by regulators and supervisors needs to reflect these realities, needs to reflect the tools available and the context of each economy. We've also seen that corporate governance and stewardship codes have been a traditional tool to regulate decision-making and protect the interests of policyholders. For this reason, often you'll find that the G of ESG, the governance aspect, is the one that there's the most guidance on in many countries. What we're seeing is that in some countries, these policies are being updated to reflect ESG factors. So take what's in place, for example, a corporate stewardship code, and expand it to incorporate some additional elements from under the E, S, and G buckets that perhaps weren't included previously. It's an interesting tool to be available to regulators. It does take time to change regulations, and sometimes you might find that there are existing regulations or existing pieces of guidance that are available that can be built on to achieve results quicker. What we've seen globally is that typically prudential supervision around ESG is taken in the form of high-level guidance, recommendations, and expectations as a first step, rather than specific enforceable measures. Although those have happened, it's common to ensure that you bring the industry along, get buy-in, and help ensure that people understand it as you go, to start with guidance recommendations. Ask individual insurance companies to make their own decisions, at least initially, around how they think about implementing and controlling for ESG risks and impact, and then look to regulate slightly later once it's more established. Just to give you a sense of how new this really is, in April 2019, so it's just over 3 years ago, the Bank of England became the first central bank and supervisor to set supervisory expectations on the management of climate-related financial risks, which covered governance, risk management, scenario analysis, and disclosure. So it is new. It does need to be context-specific. And this is very much a journey, and it's a journey for regulators and supervisors to take, but also for the industry. And what we strongly believe when dealing in cases like this is that where the industry and the supervisors work closely together and have dialogue, you end up with much more solid implementation plans and solid results at the end. Some common themes we're seeing coming out from supervisory expectations globally. One of the things that's commonly asked for around governance, but more broadly around ESG, is embedding those issues in decision-making, not just in risk analysis and risk management, but also in decision-making around the company's strategy, the underwriting decisions, business operations, and in the case of insurance, in investment decisions as well. From a risk management framework perspective, we're seeing a request to provide evidence on how the firm mitigates financial risks by looking at the way that they monitor progress against business strategy and risk appetite, as well as how they identify and measure risks using scenario analysis and stress testing. And that's particularly true for climate-related risks. Being able to understand the impact of climate across the product set, but also on the solvency, liquidity, ability to pay policyholders, all of that can become actually a keeping your license issue for insurers. So it becomes really critical. And it's for that reason that supervisors are honing in on it. They want to make sure that insurers and the industry as a whole are sustainable in that sense. Disclosures are common, often voluntary disclosures at first. They're used as a tool to demonstrate accountability and transparency, also to give insurers a chance to work out for themselves how to design the right systems internally and the right processes to understand and mitigate these ESG risks. Investment as well is common. Of course, insurers are also investors. Adopting a sustainable approach to investments, diversifying assets, those things talk to the survivability of a business and the sustainability of it. And then we've spoken about climate and strategy and business model. And one of the things that I think is perhaps most interesting about responding to climate risks and changes in the frequency and nature of those risks is the impact across an insurance company's portfolio of products. It's not just disaster products or agricultural products that need to be take careful note of this. It's also products relating to business interruption, in many cases relating to mortality, so life and funeral products. And really this does touch everything within the business from a customer-facing lens, as well as from a sustainability lens internally. So there are these nice global examples of some common supervisory expectations coming through. And the work that we've been doing that's still underway with FSC Africa is really to help insurance regulators work out how to integrate these considerations. And to do that, we're really asking three core questions. What's the status quo of ESG adoption in country currently? How can insurers better integrate ESG considerations into risk management, underwriting, and capital adequacy processes? And then how can insurance regulation or policies integrate ESG considerations? In other words, what should be done to help the insurance industry to adapt? So I'm going to quickly take you through the work that we've been doing in these countries. Starting with just the current status, a lot of this aligns very nicely with the three key findings that Thomas introduced from his work that's been running in parallel. We find consistently that actually attitudes towards ESG adoption from insurance companies are positive in Ghana, Kenya, and Nigeria. So the respondents know about it. They believe that ESG will have a high priority in their organizations. And it's interesting to see that the reasons that they believe integrating ESG factors into their businesses will be important are quite interesting to me. The first is being able to signal a corporate commitment to sustainability. So this already looks at externally, how can the company present itself? And that's signaling that commitment to customers. Signaling that commitment to shareholders actually was also on the list, but a little bit further down. It also helps to identify potential risks. So although these risks have existed and continue to exist, the ESG framework gives you a chance to make sure that you don't have any blind spots and make sure that you're taking adequate or adequately incorporating these risks. And then finally, it serves to improve internal accountability with respect to risk management. Just to flick through, I won't go through all the details. There's a lot of consistency between the three countries in terms of the main reasons for integrating these risks. So you'll see corporate commitment, being able to signal that to customers and investors comes through a lot. Identifying risks and internal accountability comes through a lot. What I do want to pull out in each of these slides is just a nice quote from the survey respondents who are insurance companies, and it's all anonymous. In Ghana, a nice quote that we received says, "Our business operates within an environmental and social space, and our relationship with our surroundings, clients, staff, vendors, suppliers, etc., is very crucial. This, in conjunction with leadership and appropriate controls, are critical to the success of the business and need to be monitored closely." So this is an insurer responding to this survey, noting that the insurance company as a business doesn't exist in isolation. It exists within a particular socioeconomic context in a particular country, and it needs to be cognizant of that as a survival mechanism and to ensure the sustainability of the business as a business in this context. And ESG is a helpful tool to enable that. In Kenya, a nice quote we pulled out, "We have a triple role to play as risk carriers, investors, and risk managers. Each of these carrying with them risks and at the same time opportunities from product development to the asset classes we invest in." This quote we like because it gives a sense of the responsibility and the multiple roles that an insurance company does play in a society, but also because it's not just about mitigating risks and preventing harm in a company. It's also about looking at opportunities to make a positive difference in society, but also through your products. And I think that's a very healthy mix. And then in Nigeria, the company believes a strong ESG proposition and integration help attract new business opportunities, combat rising operating costs, meet competitive challenges, and speed up growth by strengthening relationships with key stakeholders, customers, and regulatory bodies. It also improves transparency and thus reduces the general regulatory burden on the company. So a number of positive aspects there that came through. In Nigeria in particular, interviews noted that this is still new and it's too broad for meaningful application. And this is one of the challenges that was mentioned right up front by Elias is often it's difficult to pin down exactly what companies should do. And that's really the purpose of this project. Some interesting challenges that came out of our industry surveys in the 3 countries. Current adoption, as Thomas suggested, awareness is high, interest in it is high, and awareness of the importance of it is high, but the practical application of ESG is still lacking, even though there is this awareness. So we know that adoption can improve. We know that the regulators play an important role in helping to address some of these challenges and encourage adoption. And what we saw coming out of our survey work is internal capacity and policy formation is a challenge faced across the board. Currently, there are medium to low levels of reporting. Often that reporting will report on the aspects of social and governance that are already in place. So a number of people, for example, already report on the gender mix of employees, and they might already report on board composition and processes, which are aspects of S&G, but it's by no means comprehensive. And there's a lot of internal reporting and review processes that need to be built out still. And finally, issues with data collection we've spoken about. I won't go through this slide. I think it's a little bit too much detail. But what we did see coming out of this kind of status quo assessment is there are opportunities across the board in these 3 countries in each of the E, S, and G pillars. Governance of the 3 is probably the most established. There's a lot more existing regulation on governance, particularly for listed entities in the 3 countries. Environmental is the one that people are perhaps have most top of mind because of the increased awareness around climate change and a number of stakeholders wanting to understand the response to that. And social, there tends to be quite a lot done in companies already on social around isolated measures like diversity or other gender measures. But there's a lot of gaps there around data protection, around actual regulatory guidance on gender and diversity, employee relations, cybersecurity. A lot of that is not currently present in the regulatory landscape. So when we then move on to think about what to do about this and how to develop tools and help to kind of adopt that, we really went in with a couple of very clear principles to inform the work. The first is it needs to be easy to implement and use. From a regulatory perspective, having done a lot of work with regulators across the continent, being a regulator is a hard job. It's hard to keep up with changes in requirements. It's hard to keep up with changes in technology. It's hard to keep up with changes in distribution models in the insurance sector. So capacity is always going to be a challenge. You need to design something that from the regulatory perspective is easy to implement and to use, but also from an industry perspective is easy to implement and use. I used to be in charge of the data team at a life insurer. And whenever there was a regulatory notice published, there would be nervousness in my team because you start to immediately wonder how much of a reporting burden this is going to be for you. And I think that's an unfair assessment of what regulators do. But certainly if you want to get the industry to buy in to something, you need to make it easy to understand, easy to use for the industry as well as for the regulators. The second principle that we've spoken about, it must be country specific. This isn't something that we can pull from the UK market and stick in blanket in the African context. And even within the African context, each of our societies operates very differently from a socioeconomic perspective. And it needs to be flexible and designed to be built on and iterated later. So all of the work that we've done in this project, the way that we've approached it is build something, treat it as something that is a foundation with the intention that it gets built on, it gets adapted, and it gets changed over time. There's no use in presenting something as a fait accompli, and this is going to be how you think about environmental risk forever. It's got to be flexible. It's got to be able to be adapted to particular countries as they change. So just to give you a sense of how we thought about this from an outputs perspective. So we developed a Word document, effectively a toolkit outline. And I've just put up the contents here. Apologies that it's so small, but just what I want to make clear is this is a simple document. It's designed to be there. That's as something that's straightforward that can be used as a base and added to over time. The first thing that we do in the document is start with setting out a common language, because there is so much ambiguity around some of these areas of ESG, and there's so many terms that people can interpret in different ways. We start with a glossary of terms. This gets added to over time. We make sure that as an industry within a country, we start with using the same words to describe the same things. We then decided on building this, as I said, very much as a living document, but building it along with, or rather with a view of an insurance operating model. If we want to make something that is implementable in an actual insurer's real life, it needs to understand what the different parts of that insurance business are and what the different aspects are. So we use this operating model as a kind of generic insurance operating model to determine the categories within which we then look at the risks and the self-evaluation questions. The idea is you don't want to leave any blind spots. You want to make sure that there's enough detail for the insurers as well as for the regulator to really understand what to prioritize. And then what we do in the toolkit is under each of the three pillars, so under the environmental pillar, the social pillar, and then the governance pillar, we try and keep it simple. We have three broad buckets or three headings within those. The first is general compliance or adherence. What we've realized is that a lot of the insurers just want to get a sense of actions they can take and things that they can do to make sure that they incorporate things. So in each of the E, S, and G pillars, we put in some examples of existing regulations or existing pieces of guidance. Some of them are international, for example, UNEP-FI, TCFD. Some of them are country specific. So for example, there are existing environmental regulations in Kenya. There's also a national climate change action plan. And those provide some nice guidance in their current form already for insurers. So the idea with the general compliance and adherence is to give insurers reference points to go to when they are designing internal policies and processes. We also did a deep dive into specific compliance topics. So these are kind of prioritized areas where we think the most ESG related risks are going to be. So for example, here we're looking in the environmental section, climate change, biodiversity and ecosystems, water and air pollution, waste management and recycling, and then energy efficiency. And the intent there is really to understand in a particular country, what are the major risks under environmental, social, and governance, and how do we make sure that we prioritize interventions and guidance to help insurers understand those, mitigate them, and look for opportunities to add impact. And then what we built is what's effectively an assessment table. So this is an assessment table that the regulator or supervisor can use when assessing the industry, when assessing individual insurers, but also it can serve for insurers to do a self-assessment. It's literally, you can go through, look at each consideration and say, do we meet that or do we do that already? Yes, partially, or no. And the idea behind that is with this self-assessment, you can then, as an insurance company, start to identify what priority areas there are for action for you. At the start, there will be a lot more gaps than you've got capacity to deal with. And really this serves as that first step towards understanding how to go about plugging some of these gaps and where to focus. I know I'm talking a lot. There are a couple more things to get through before I call on Hafiz to answer some questions. The other thing we put in is what we call the cheat sheet for regulators. Through the ongoing engagement in all three countries, what we realized is as a regulator or supervisor, you need to be able to, not just at a leadership level, but throughout the organization, talk about why insurers should care about ESG. If you want the industry to understand ESG and care about it and know what to do about it, as an internal regulator or supervisor, you need to be able to have that consistent messaging and have that cheat sheet for your staff to be able to talk to regulators. So that was something that we didn't come in planning to do, but something that we added into the project and I think ended up being really valuable. Very quickly, we've also built a draft guidance note. It's not a let's say it's not a regulatory document in the sense. What we've tried to do is build out guidance in addition to the toolkit for the regulators to think about offering to the industry and to use this as a way to guide the industry. But all of this happens in, I think, a sort of 5 or 6 step process. And really having this toolkit and having some guidance note details is the start of a journey of encouraging ESG integration into the industry. And for those of you who have worked at supervisors or regulators or been involved in regulatory change, you know that takes time and there's a lot of stakeholder engagement required to get it right. So ultimately, I think the goal should be for insurers to include ESG considerations in strategy, governance, system, policy, reporting, operations, but it needs to be introduced incrementally. It needs to take account of the country's context and industry maturity. You need to know what the industry knows, what's possible, and take a pragmatic approach in defining what's likely to succeed. It's no good going in and asking for an overwhelming amount and something that's not realistic. You need to be pragmatic. And with that in mind, we've kind of pulled out these sort of 5 steps, which we think are a kind of pragmatic and realistic roadmap to incorporating ESG considerations. All of these will require stakeholder engagement. The first is internal capacity building at the regulator. It's not just the cheat sheet. Your staff needs to understand ESG, needs to be able to talk about it with authority and with clear understanding. The second step is external capacity building in the industry. So creating an awareness of ESG more broadly, engaging with industry to understand their perspectives and answer their questions. You don't want this to become a compliance burden or a tick box exercise. Then providing guidance. So guidance notes or similar, something that helps the industry respond and navigate ESG and define their own approaches. There could be examples or opportunities for potential pilots with some insurance companies here. But really, this should serve as an opportunity to test out how the industry is responding and to give some guidance on activities and interventions that they can then integrate into the way that they run their businesses. We think an interesting step after that is looking at additional incentives for insurers to integrate ESG. For example, perhaps there are actions around green bonds or interest rates or capital adequacy requirements that could help to really trigger an interest and incentivize the right behaviors once you've defined what those are as an industry, so that solutions become something that are incentivized, but also something that you kind of have co-created in a way with the industry. And then if it makes sense, consider regulation. That's obviously, it takes time. That process. And you might find at that point that it's definitely something you want to do, or maybe something that doesn't make sense to do. And within that, you've got a lot of options as well. You can augment something that exists. You can combine a whole lot of existing guidance from capital markets, from financial sector, from listed entities into something new, or you can build something completely new. I think that is the fuzziest part of this process, and I think necessarily so, because this is a journey to go through. So I see Hafiz laughing at me with my fuzziness comments. So let me quickly introduce Hafiz, and then I've got a few questions that I'm going to ask him to get the supervisory perspective. As we're going, please do put questions for Hafiz or Ryan, myself, Elias, Thomas into the chat if you would like. So to introduce Hafiz, he's an insurance risk analyst. Presently, he's the head of the Innovation Hub of the National Insurance Commission, or NIC, which I'm sure a lot of you know about in Ghana. Prior to this role, he served as the head of the Licensing and Financial Analysis Unit of the National Insurance Commission between 2017 and 2019, and he joined Enterprise Group from February 2019 to 2020 as a risk manager. He's a graduate of management studies and an associate of the Chartered Insurance Institution in the UK. So Hafiz, thank you again for giving up your leave. I'm going to stop sharing my screen now, so we can put you on the main screen. And Hafiz has kindly offered to answer some questions from the supervisor's perspective today. So looking forward to this very much, Hafiz, and thank you. The first question we have for you is a very general one. From the insurance supervisor perspective, what is the view of ESG? Why do you think it's important, if indeed you do think it's important? What is kind of the internal view of it as a concept?
So for the National Insurance Commission, ESG have always remained with us except that the prioritization of same hasn't been more present than it has been now. For the National Insurance Commission, ESG is more about sustainability, but the issues are more of the components and etc. So what we have been looking at in the last few years is to be able to look at sustainability in the social aspect and the governance aspect of the ESG. What has actually been missing is the environmental aspect. So if you look at the frameworks that we have frameworks around governance, which is the corporate governance and risk management framework, which has a lot of extensive requirements on how to ensure corporate governance around regulated entities. And on the social aspect of the ESG, there are a number of market conduct rules presently that deals with customer treatments and to ensure ethical play in the insurance space. But with the ESG in its more broader sense, you're actually looking at ensuring that there is social inclusion, there is environmental protection, and most importantly, we are looking at ensuring resilience with internal and external shocks. And so to be able to deal with this, what the NIC is presently looking at is to have to look at it in a more concerted way rather than look at it in separate legs. And so we know that ESG is interlinked, but all the components have its own specifications and specificity. And because of the uniqueness of each component, you need to be more direct and more intentional with the way you bring about these things. So the NIC actually is going into a discussion on its next strategic plan. And one of the key elements of the discussions would be around ESG. And we want to ensure that ESG is a key imperative in the NIC strategic plan, just so that we can develop a framework that has extensive requirements that can get regulated entities to have ESG as part of their processes. Thank you.
Cool. Thanks very much for that, Hafiz. And I think you've started to mention some of the benefits that you guys see internally. I wonder if there are additional benefits to that, but also, do you see any major barriers to incorporating ESG considerations? Like, what is it about this that might be difficult in the Ghanaian context, but perhaps as general lessons in other geographies as well?
Yes, so let me deal with the benefits, then I come to the barriers associated with that. So the benefits, a key benefit is sustainability. We want to ensure that regulated entities have sustainable business processes and models so that you do not have risks that they do not pay attention to degenerate and then it affects their value propositions and etc. We also want to ensure that there is transparency between what's entities in the insurance industry are doing and what the general public and the general society is able to appreciate around that. The barriers are quite anecdotal in my sense, because some of them are perceptions. So for example, there is this huge perception out there that ESG is largely an issue for OECD countries, and because they cause enormous issues around carbon emissions and so on. And so they feel these are risks that are very remote to us. And there's also these issues around full understanding about ESG and what it really means, even though it has remained with us and so on. And so these are some of the things that we need to deal with in order that we can be able to get regulated entities to buy into the whole framework about ESG. So on.
Cool, thanks very much for that. And I'm curious about this, and having watched the NIC for a few years, and to me noted how well some of the regulatory changes have landed because of the stakeholder engagement process. I wonder if you could talk us through that. Like, how important is it to involve stakeholders when making changes or providing guidance on something like ESG? And which stakeholder categories do you at NIC consider to be important as part of this consultative type process?
All right. So for stakeholder engagements, it is very key because whatever it is that ESG would do, it would have direct effects on the stakeholders. And so for the NIC, we are looking at it broadly. We are looking at even the internal stakeholders. We want to ensure that we build the capacities of staff to really understand what ESG is. Beyond that, we want to engage regulated entities. It will be a top-down approach where from the senior management and board level, you have a buy-in on what ESG is and so on. And then that will trickle down to the very divisional levels of every organization, or every entity. So it is very important that we have all of this in a more organized and concerted way. So for the NIC, we are looking at a more medium and long-term approach so that there is more buy-in into it before we roll out ESG. Well,
great, thanks very much, Hafiz. And maybe one last question for you before I go to the Q&A. So if anyone does have questions, please pop in the Q&A. Is when undergoing a process like this of integrating ESG, so something that's relatively new and, as you say, requires a stakeholder engagement and education and awareness, how does a supervisor think about timelines? So you started to talk about short-term, medium, long-term. How do you think about setting those kind of guidelines for this kind of integration internally?
Okay, so in terms of the roadmap, like I stated earlier on, the strategic plan of the NIC would actually capture a roadmap for the implementation of this ESG. And the key element of it is to actually focus on the educational and the capacity building aspect of it. That would be the early things that we'll do. So internally and externally, those are the things that we'll do. Beyond that, we are also looking at the issuance of non-prescriptive guidance. We've received a number of support from the FSD on these guidance. And so we are looking at issuing these non-prescriptive guidance just to give a sense to the regulated entities about ESG so that there is an understanding of what ESG really means and the need for them to pay attention to ESG risks around their business processes and so on. Beyond that, we would also be looking at ways of incentivizing these entities to be able to have ESG as part of their business process. And one of the key things I saw in your slide that we are also looking at, for example, we can look at the capital adequacy assessment, whether if you have things that ensures that you adhere to ESG principles, and we can incentivize entities that are able to do that. So that when you are determining their capital adequacy, you look at. There are also prudential requirements that we may look at. But on the more broader level, the aim is actually to get to a stage where we would have to get that into regulation and get all insurance companies to abide to ESG requirements.
Yeah, thanks very much for that, Hafiz. And I think one of the thoughts that triggers for me is that in countries where microinsurance regulations have been put in place, there's a lot to learn from that, because many of the microinsurance regulations involve things like changes to capital adequacy requirements and reducing barriers to entry. So I think there's a lot of learnings from kind of parallel processes that have been in place as well. We've got time for a couple of questions before we close out. The first question I'll answer very briefly from our work, but I would love to get your view on it, Elias, and then also yours, Mohammed, following Elias. The question is from Hazel. She says, what role have insurance associations played in other markets in driving ESG knowledge and industry adoption? So we can think here about other markets that you have noticed, Hafiz, from the NIC, where you look to the way that regulators have handled things like this for guidance and benchmarking. And also, Elias, it would be great to get your views from FSD Africa, as someone who works with and watches regulators across the world. Which regulators you think are interesting, and where you've seen insurance associations do things that are interesting. To answer very briefly from our research on this project, around ESG specifically, it's helpful to look at the UK and EU, just because a lot of the regulations start there. They lead a lot of the developments in the ESG space. I think Singapore can also sometimes be useful from an industry perspective to have a look at the supervisory practices there, though of course it is quite different. In the developing world, Brazil, I mentioned, is a good one. You have to work out how to translate all the documents, but that's an interesting regulator and industry to look at around ESG and similar. Mexico is interesting, and I think South Africa on the African continent is interesting as well, just because often the regulations come through South Africa and changes get made in country that are often then followed in other countries as well. So I think from our perspective, those are some interesting ones to look at. This question is specifically around associations, but curious to get, maybe Elias, I can start with you. Are there any insurance supervisors and regulators or associations that you've seen doing a really good job in driving ESG knowledge and industry adoption globally?
Right. Thank you very much for that question, and thank you, Hazel, for that. Ideally, if you look at different jurisdictions in terms of the process of developing regulations, we've seen more of regulations, strategy following regulation than regulation following strategy, particularly in Africa, whereby any regulation is seen as either a new cost before it ideally embedded within the business strategic outlook. So that basically means that within that, then associations are really, really important in terms of making some of these particular regulations even get full traction within the market. So, and that's maybe if you look at the Kenyan side, you'll be able to see that before any regulation is released, there's what we call public participation. I've also seen that happening in so many other jurisdictions in the continent, whereby the regulator has to really engage the public in term before some of these guidances and circulars and law is ideally released. But from an ESG point of view, here we are talking about real risks that we've already experienced. And that really means that there's need for different stakeholders to work together. And my advice would be, rather than waiting for involvement on a process that has already started, it will be important for associations, particularly insurance associations, pension associations, asset manager associations, to basically come together and lead this course, because ideally these particular risks will highly impact the profits, will highly impact many business processes and operations that in one or the other can influence the bottom line in many other facets. So my advice would be, we just need to start working around this particular agenda and push that agenda towards even really involving the regulator for those particular countries that haven't really initiated this particular course. Now, for instance, Kenya now, there's an opportunity for association to work closely with the sector policymakers and regulators. In Ghana, we've already set pace by working with NIC, and I believe that the association there will basically will be integrated and incorporated in that particular journey, but also in Nigeria, where this work has already happened. So we are basically discussing real risks that will mean that we don't really need to wait for it to drive for regulation to drive strategy, but for the strategy now to start driving regulation and taking us to a more sustainable world. Thank you.
Great, thanks, Elias. I think nice, very nice comments there. Hafiz, anything to add from your guys' perspective at NIC?
Yes, so I would just limit the conversation to Ghana. So at the governmental level, the government of Ghana in 2013 issued the climate change policy. In fact, that policy actually sets the tone, the E aspect of the ESG, which for me is a very important document for all the regulatory sectors in the financial services space to look at. And beyond that, I know that the Bank of Ghana that has oversight responsibility for the banking sector are also paying particular attention to ESG issues. And so there is actually the Financial Stability Council where all the financial services regulators sit. And one of the key things that are beginning to take center stage in discussions is ESG. And for me, that is very important for the Ghanaian experience. And for the regulatory, the associations, and from the insurance sector, we have the Insurers Association, one of the biggest associations in the insurance space. And one of the things that the NIC is looking at is to get the association very part of this whole process, so that the association will be able to get their entities to be very involved in the discussion, especially when we begin to issue the non-prescriptive guidance to these entities.
Great, thanks very much, Hafiz. Cool, we are drawing to the end of our time. There are no more questions in the Q&A, but I'll just put my email address in the chat. If anyone does have questions in the coming days, please feel free to reach out. I'll happily engage on them and coordinate responses. Before I hand over to Elias to formally close us out, from our side at Genesis Analytics, thank you very much for joining. We really appreciate your time. I know that there are millions of webinars and conferences and various things on the go. So really appreciate you spending some time with us. Thank you to Hafiz and the team at NIC, as well as to the other regulators and their teams in Kenya and Nigeria, to Elias and team at FSD Africa, and in particular to Angela, who's been running the event in the background and coordinated just about everything from a logistics perspective. So thank you all very much. Elias, please go ahead, and you're welcome to close us out.
Right. Thank you very much, Mark, and also for basically steering this particular session. Ryan, thank you for your time and basically engaging us during the opening and providing some key remarks on ESG. Hafiz, thank you. And we are really, really happy that we've worked with NIC Ghana as one of the countries that we are implementing this particular project. We've also worked with Kenya, in particular Moses Kipton, and also in Nigeria with the team there, and we are happy that this particular discussion is gaining the right traction. Now, we cannot overly emphasize the importance of the insurance sector, particularly the insurance companies and regulators in driving global sustainability. And that basically means that in terms of how businesses will be conducting their operations in the near future, need to be really in line with issues around sustainability and ensuring that we can make the world become more resilient with the various risks that are currently being faced within this particular continent. Also, we know that the regulators need to create an enabling environment that is fit for purpose, and also kind of providing really proportionate regulations, because different continents and also countries will have different impacts. And that really means that we need to create an environment that will enable insurance industry players to assess their risks towards ESG, but also to seize opportunities that this particular new discussion and new dispensation is bringing, because we are not only talking about the risks that will be arising out of this ESG, but also the opportunities in terms of investments, and we've seen already discussions around green bonds within this particular financial sector. We've seen products being developed. So it kind of also provides a very good ground for financial sector institutions to develop and to seize the opportunity that this new dispensation is bringing. So my urge is for us to work together as different stakeholders. FSD Africa is keen to support this green discussion, given that our role is to make finance make for Africa, to make finance work for Africa future. We are highly keen to ensure that the world, particularly the African continent, becomes more resilient, but to support its future. So we will be working with different players. We are working with insurance regulators, the policymakers, the insurance industry players, to ensure that within this journey, because this is a journey, we will not be able to say that we have fully addressed all the risks maybe within 1 year, but it's a journey that we are ready to take, and we are ready to support the people that are like-minded to see Africa becoming more resilient and more sustainable. So mine is just to thank you for the time that you've taken to join us. Our emails are available. So in case you want to reach out to us, you can reach out to me at elias@fsdafrica.org. And also you can reach out to Ryan and Mark. If you have questions, we are happy that we'll continue this discussion, and always watch and follow us on our various social media handles, because we'll be having more of these discussions going forward. In case you're interested in some of the documents that you've already worked on, let us know, and we will be happy to engage. I will just stay on for a bit and put my email on the chat. For this time, thank you very much for joining us, and continue following us on the various programs that we'll be undertaking in the near future. Thank you for the time being. We'll also be able to share the slides as long as we had your email addresses during the registration. Thank you very much. Until next time, enjoy the rest of your day. Thank you.